Greetings and welcome to the Wealth for Real YouTube channel. I'm your host, Christopher Anastasio. It's Tuesday, September 26th, 2023, and I'm going to be talking to you guys today about who should be setting interest rates. You can see in the background here, I've got this article from December 2nd, 2019, Dr. Roy Cordato writing the article, Interest Rates Should Be Set by the Market, Not the Fed, and that's on johnlocke.org. This was something, guys, that I, just to give you a little background on how I landed on this article. It was actually a couple of months ago. It's taken me a little while to really just sit down, read through it, think about how I wanted to present it to you guys. But I'd been thinking about some arguments that I'd seen, excuse me, about, what constitutes a free market. Do we have one? Do we not have one? There's always some debate going on online about that. I think we've all kind of seen that if you have any interest in this area. In that debate, I noticed there would always be some kind of discussion about, prices and setting minimum wage and, all this kind of talk about different economic controls, if you will, price setting, you get the point. What was never brought up, what I never saw anybody say on either side, I'm talking about either side of the argument, not necessarily by the pro-free market or the anti-free market or the pro-socialist or anti-socialist, would be, why do human beings, 12 of them, if I'm being accurate about how many Fed governors sit around a table and come up with the interest rate, why do 12 human beings have any sense of what money costs when we already know they have no sense of what, bread should cost or eggs should cost or gas should cost or rent should cost or whatever, right? If we've generally accepted that they don't know what those prices should be, why do we think they know what these prices, interest rates, should be? And so I just never saw substantive debate about it. I mean, honestly, besides this article right here that I'm showing you guys, I haven't seen anything about it. Now, I think part of that's just not looking hard enough for it. Part of that's not looking in the right places. But it's just interesting that in following the discussion trail, it never came up. It never presented itself just sort of like along the way in a way that I would have run into it. So anyway, guys, this article, I definitely recommend it. I just posted it within the last 10 or 15 minutes to the Facebook page. Let's just go in there and make sure it's there. Yep, there it is. Put a couple brain emojis on it. Interest rates should be set by the market, not the Fed. So if you guys want to read this article, it's in the feed there. But I wanted to highlight a couple things for you guys here, and just do some quoting and some commentating along the way. You get the intro here about if asked who sets interest rates in the economy, most of us would answer the Federal Reserve. Okay, so that's kind of the table setter. So let's go to this paragraph here, worth quoting. Clearly, economists recognize that the most efficient way for prices to be determined is through the free interplay of buyers and sellers making decisions based on their own preferences. Neither the head of a central pricing board, like the Fed, or the president of the country can know what these prices ought to be. And yet, when it comes to the price that we call the interest rate, my quotations, both the central pricing board, the Fed, and the president think they know precisely what the right price is and seem to be in complete disagreement about it. Now, remember, this was in 2019, so the author presumably is referring to President Trump and Jerome Powell at the Fed and his board of governors. So this is just kind of a table setter as well. This is how efficient pricing is established. Nobody should or could be able to know it, right? So then you come a little bit further down, and I like this paragraph about the function of interest rates. From an economic perspective, what is the function of interest rates? In a free market, interest rates are the price for loanable funds and are determined by the interaction of the supply of funds available for lending and demand for those funds by borrowers. The supply of loanable funds is the amount that people are willing to save at different interest rates, and the demand is determined by the amount people would be willing to borrow at different rates. Like in other markets, the prices, in this case, the interest rates, are determined by the interaction of these two components. So again, it sounds very basic. I think if you're an economics major or you've just been steeped in this stuff for a long time, that paragraph probably puts you to sleep. But for somebody like myself who is interested in this stuff, but I don't really come with the technical credentials, it's nice to hear somebody break it down this simplistically. Like, this is what this is what an interest rate is doing between these two sides of the market, the loanable funds and the borrowers, the supplier of loanable funds and the borrowers. And so I thought this was a nice little paragraph here that kind of like, if you're really not 100% there in terms of, why is there such a thing as an interest rate, this is a nice explanation of it. So in this paragraph, the very next one, I like how it kind of lays this out, particularly the second half of the paragraph. It talks about, the question is what determines the supply and demand. And he talks about time preference, people's preferences for wanting to make purchases further into the future relative to the near term. So the more people who are focused on the future, making a down payment on a house, saving for children's education, preparing their own retirement, the more they want to save at any given interest rate. And he goes on to say here, demand for loanable funds comes from anxiousness to make near-term purchases on consumer goods like TVs and computers, but also entrepreneurs and business people looking to start up or expand operations. People looking to borrow money will be willing to borrow more at lower interest rates than at higher rates. Suppliers of funds will be willing to supply or save more the higher the rates and less at lower interest rates. And it is the interplay of these forces that in a free market will determine the actual market interest rates, unless, of course, the market interest rate is subject to Fed manipulation. So I thought this was a nice way of going down a layer and kind of even giving you some examples of why are people saving, why are people borrowing, supplying the funds, using the funds, that sort of thing. So really like that paragraph. I think that is a nice summary of how that dynamic unfolds. And then let's see. Okay, so in this paragraph about the fully determined interest rates, when you get about halfway through it, increased savings reduces interest rates, makes borrowing on the part of entrepreneurs and businesses cheaper, which means it makes longer-term investments that will produce goods and services further into the future more profitable, and more future goods will be produced. The interest rate this is the critical part right here, guys. Actually, I'm going to put a little highlight on it. The interest rate is performing the important function of coordinating the preferences of consumers with the plans of producers through time. It is part of the marvel of how free markets work and create orderly production decisions that are consistent with people's preferences. I think this is probably, if you had to boil it down to one or two sentences, probably the best two that you're going to get if you're sort of punctuating the function of interest rates and why it's so important that interest rates kind of vibrate in a free market. So really, really like that quote there. And then he kind of finishes it off here, guys, in the conclusion, which of course I roundly support. The Federal Reserve should pull out of the interest rate manipulation business completely. Having a Fed whose main job, at least in the eyes of the public, is to set or move interest rates in centrally determined directions makes no more sense than having a powerful government agency determining what should be happening with any other price in the economy. If the Fed could know the right price for loanable funds, then there is no reason to think they couldn't also know the correct price for shoes, computers, or food. It is the fact that neither the Fed nor any other central authority can know the right price for any of these products, interest rates included, which makes efficient socialist central planning impossible. So I think this is just a very, in my opinion at least, very unemotional, very straight factual way of representing this side of the argument against central planning. And if you are for central planning, I think this is the argument you have to attack first. You have to explain why this is not true, or you have to establish on the positive side of the argument how, why it is feasible, why it is possible, right? Maybe you don't necessarily have to deconstruct this, but you have to be able to say, like, well, here's why we can centrally plan. This is why this is why we can know the price, right? And of course, I'm hyper skeptical of that, and I fall out on this side of the argument here. But I just really think it's perfectly summed up here in this conclusion on this article by Dr. Cordato. So I think, the thing that I want to kind of focus on going forward, guys, with this, I most certainly will return to this article at times, but I think there's something about this that has to be taken a step further, which is, okay, Chris, since they do centrally plan the cost of money, right? Since there is a Federal Reserve planning interest rates, planning the cost of money, what effect does that have? Who does that benefit? How does that benefit them, Why are they doing that? Those questions are natural outgrowths of this very straight line, fundamental, soundly produced argument in this article. But I think it's natural then to read this, digest it, and say, okay, but they are centrally planning the cost of money. Why is that? Is somebody having a vested interest in that? Who's benefiting from that? Who wants to keep it that way? Certainly, I think an argument is being made here for why we should change that, right? Like you could make a very derivative argument out of this one that we should stop having the Federal Reserve set interest rates and we should just let the market do it, right? Well, of course, we know that's not going to happen, but why isn't that going to happen? Why specifically, if the Fed isn't interested in setting the price of bread or eggs or gas or shoes, why are they interested in setting the price of interest rates? Like what zeroes them in on that particular thing and has them doing that and continuing to do that? And then I think when you start answering that question, you start understanding like, okay, this is why they're doing that. This is who it's benefiting. This is why they want to keep it that way, and so on and so forth. So I think that's the outgrowth argument that comes from this really outstanding article here. So very much appreciate you guys listening to this. Would love to hear what you think about it. Would love to see comments, questions, drop them down below, and would love to tackle those or just read what you guys think, what your insights are on this. Do you agree with the article? Do you disagree with the article? Why do you think the cost of money is centrally planned? Any of those things, would be super interested to hear what you think, guys. So until next time, hope everybody has a great Tuesday night. Thank you again for watching. Thank you again for supporting the channel. If you haven't already, please hit the subscribe button below. And like I said, drop a comment or a question. Thanks so much, guys. Till next time.